Here is a question that most financial advisors will not ask you. If you woke up tomorrow and every major news channel in the world was showing the same headline that a third world war had officially begun, what would you actually do with your money? Not what you think you should do. Not what some Reddit thread told you to do 3 years ago. What would you actually do? Because the uncomfortable truth is that most people, most educated, employed, reasonably intelligent people, have no answer to that question. Not because they have not thought about money, but because they have been thinking about it in the wrong order, for the wrong reasons, in a world that no longer exists. Today, we are going to fix that, calmly, with numbers, and without pretending the world is simpler than it is. Part 1. The world has already shifted. Let me start with something that is not hypothetical at all. The geopolitical environment of 2025 and 2026 is genuinely different from anything most working adults have experienced in their financial lives. We are not talking about a recession. We are not talking about a market correction. We are talking about a structural shift, a rewiring of global trade, energy supply chains, currency alliances, and military spending that has not happened at this scale since the 1940s. NATO defense budgets are at historic highs. European governments that spent decades as pacifist economies are now openly debating mandatory military service. The United States is reassessing every supply chain that runs through a geopolitically sensitive region. Taiwan, the Middle East, Eastern Europe, 3 separate fault lines, all active simultaneously. Now, does this mean WW3 is starting tomorrow? Probably not. But here is the thing about financial planning that almost nobody tells you. You do not plan for what is probable. You plan for what is possible, and you build a structure that survives across multiple scenarios. The investor who survives a financial crisis is not the one who predicted it. It is the one whose portfolio was already structured to handle uncertainty before the crisis arrived. And right now, most middle-class people in the United States and Europe are not structured for uncertainty. They are structured for a world that ran on cheap money, stable supply chains, and predictable inflation. That world ended, gradually, and then all at once. So the question, what is the smartest order to invest your money if WW3 starts tomorrow, is not really a question about war. It is a question about whether your financial structure is honest. Whether it was built for the real world or for a version of the world that no longer exists. Let's find out. Part 2. Meet Daniel and Sophie. I want to introduce you to 2 people. They are composites, meaning they represent patterns that appear repeatedly in financial data and in how ordinary people in the US and Europe actually live. Daniel, Columbus, Ohio. Daniel is 31 years old. He lives in a mid-sized city, let's say Columbus, Ohio, though it could just as easily be Leeds in England or Lyon in France. He works in marketing operations for a mid-sized company. After taxes and social contributions, his monthly take-home pay is around $3,800. He considers himself financially aware. He has a 401k. He checks his bank account regularly. He does not think of himself as someone who is bad with money. Here is what Daniel's month actually looks like. Rent, $1,150. Car payment, $390. Car insurance, $140. Fuel and parking, $90. Grocery and household, $380. Phone and subscriptions, $110. Student loan minimum payment, $230. Credit card, balance $9,800, carried most months. Eating out, social spending, small purchases, $9,420. Total outflow, $2,910. That leaves Daniel with $890 per month. On paper. In practice, most months something comes up. A car repair, a vet bill, a flight home for a family event, and that $890 shrinks to something much smaller. Some months it disappears entirely. Daniel has $4,200 in his checking account. He has about $11,000 in his 401k. He has no other investments. He thinks of himself as working on it. Sophie, Amsterdam, Netherlands. Sophie is 34. She lives in Amsterdam, though this pattern exists just as clearly in Stockholm, Dublin, Berlin, or Toronto. After taxes and Dutch social contributions, her take-home is around €3,200 per month, which is a solid income by any reasonable standard. Rent, €380. Scooter loan, €180. Consumer credit line from 2-year prior, €150. Groceries, household, transport passes, €340. Phone, streaming, gym, €95. Social life, €310. Total, €2,455 night remaining, €745. Sophie has €6,800 in her savings account. She contributes to her employer pension plan. It is mandatory in the Netherlands, but she has no independent investment portfolio. She has also not thought seriously about what she would do with her money if the structural stability she has built her life around, Dutch social systems, EU economic coherence, NATO security, began to fracture. What they have in common: they are not broke, they are not irresponsible, they are not the people financial channels typically talk down to. They are genuinely doing reasonably well by the standards of their peer groups. And yet, if a major geopolitical crisis began tomorrow, neither of them has a financial structure that would survive it. Not because they made dramatic mistakes, but because the order in which they approached their financial lives was built for a world of stability that may not continue. Part 3. The wrong order. Here is the core problem, and it is not the one you are expecting. The financial mistake that Daniel and Sophie are making, the one that most middle-class people in developed economies are making, is not that they spend too much on coffee. It is not that they failed to invest early enough. It is not even that they carry too much debt, though that is part of it. The mistake is that they built their financial life in the wrong order. The hierarchy of financial resilience. There is a sequence to financial resilience. A logical hierarchy of what needs to be in place before the next layer makes sense. And that hierarchy is not complicated, but it is almost universally misunderstood, because the financial industry has a significant commercial interest in getting you to skip the foundational layers and move directly to the profitable ones. At the base, you need liquidity, cash that is immediately accessible and costs you nothing to hold. Above that, you need what I would call a liability ceiling, a point at which your fixed monthly obligations are low enough that you could survive a significant income disruption. Above that, you need exposure to assets that hold value during currency instability. And only above all of that does traditional market investing make sense as a primary strategy. Daniel and Sophie, like most people their age, have inverted this hierarchy. They are participating in equity markets through their retirement accounts while carrying high-interest consumer debt. They are investing for long-term growth while sitting on 4 weeks of liquid savings. They have built the top floor before the foundation. Why the stable world masked this problem? In a stable world, in the world of 2015 or 2018, this approach was not catastrophically wrong. Markets went up, interest rates were low, the cost of carrying debt was manageable. The pension plan or 401k quietly accumulated. Everything looked fine because the environment was forgiving. A geopolitically unstable world is not forgiving. In a world where supply chains break, where energy prices spike, where governments redirect fiscal policy toward military spending, where inflation becomes structural rather than cyclical. The thing that kills middle-class financial stability is not a stock market crash. It is illiquidity. It is being forced to sell assets at a loss because you have no cash buffer. It is carrying a fixed monthly debt obligation in a period when your income becomes uncertain. The COVID proof of concept. Think about what happened during the early months of COVID. The stock market dropped roughly 34% in 5 weeks. Millions of people who had their money correctly allocated by conventional wisdom in diversified equity portfolios watched their portfolios fall dramatically at precisely the moment they needed liquidity. Some of them sold at the bottom, not because they wanted to, because they had no choice. Their emergency funds were insufficient. Their fixed obligations continued regardless of what the market was doing. The people who navigated that period with the least damage were not the ones with the best stock picks. They were the ones who had the right financial structure, the ones whose foundation was solid before the crisis arrived. WW3 is a more extreme version of the same principle, except the disruption would be faster, deeper, and more structurally permanent. Part 4. The correct hierarchy. I want to walk through this carefully because I am not going to give you a list of assets to buy. That is not what this is about. What I am going to give you is a sequence, a logical order in which to think about your financial decisions when the world has become genuinely uncertain. Layer 1. Liquidity. Before anything else, before additional investment contributions, before extra debt payments, before optimizing your portfolio allocation, you need accessible cash, not invested cash, not a retirement account you can technically withdraw from with penalties, physical or near physical liquidity. The conventional advice is 3 to 6 months of expenses. In a genuinely unstable geopolitical environment, I would argue the floor is 6 months and the ceiling is 12. For Daniel, 6 months of his actual expenses, not just the basics, but his real monthly outflow, is approximately $17,400. He has $4,200. He is at less than 1 month of coverage. This is not a minor gap. In a period of rapid geopolitical escalation, the first financial casualty for ordinary people is employment stability. Supply chains break. Companies freeze hiring. Contracts get canceled. The middle management jobs that Daniel and Sophie work in are among the first to be restructured in a crisis. If Daniel loses his income for 3 months, he is in credit card debt within weeks. The first priority in any unstable environment is to make sure that does not happen. Layer 2, liability reduction. This is the one the financial industry least likes to talk about, because reducing debt does not generate fees. But in an environment of elevated and potentially accelerating inflation, in an environment where interest rates have already repriced significantly upward, carrying variable rate consumer debt is one of the most expensive financial decisions an ordinary person can make. Daniel's student loan, at a fixed rate, is actually manageable. But the credit card balance, even if he pays it monthly, most months, has an annual percentage rate somewhere between 22% and 28%. Every dollar he carries on that card is generating a guaranteed negative return of 22-28%. No equity portfolio in history has reliably generated 22-28% annually. The math is not complicated. Eliminating high-interest debt is the highest return investment available to most middle-class people, and almost nobody frames it that way. In an unstable world, this matters even more. If your income drops, your fixed obligations become a trap. Reducing them before a crisis is the definition of financial preparation. Layer 3. Inflation-resistant assets. This is where the geopolitical dimension becomes directly relevant to investment allocation. In a world of active geopolitical conflict, even of serious geopolitical tension, certain asset classes behave differently from others. Gold has a 5,000-year track record as a store of value during political instability, not as enthusiasm. As a historical observation, physical gold, or gold-backed instruments, have preserved purchasing power through every major war, currency collapse, and political upheaval in recorded history. Commodities more broadly, energy, agricultural products, industrial metals, tend to appreciate during supply chain disruptions. If you think about what a serious geopolitical conflict would do to oil supply routes, to grain exports from conflict zones, to the price of lithium and rare earth minerals, you understand why commodity exposure is not speculation in this context. It is a rational hedge against a specific, identifiable risk. Real assets, property, in jurisdictions that are geopolitically stable also serve this function. The challenge for most people at Daniel and Sophie's income level is that direct real estate investment requires capital they do not have. But real estate investment trusts in stable markets provide a partial substitute. Treasury inflation-protected securities, TIPS in the United States, index-linked gilts in the UK, are the government's own instrument for protecting purchasing power against inflation. They are not glamorous. They are not going to generate 15% annual returns. But in a high-inflation, high-uncertainty environment, they do exactly what they say. Layer 4. Traditional market exposure. Index funds are not wrong. Diversified equity portfolios are not wrong. The 401k contribution is not wrong. What is wrong is treating these instruments as the primary or foundational layer of financial security, rather than the top layer of a structure that has been properly built from the ground up. In a geopolitically unstable world, equity markets are volatile and sentiment-driven. The S&P 500 does not care about your retirement timeline during a war. It responds to fear, to capital flows, to currency movements, to supply shocks. The investor who has strong foundations, liquidity, manageable liabilities, inflation-resistant assets, can hold equity positions through volatility because they do not need to sell. The investor without those foundations becomes a forced seller at the worst possible moment. This is the order. Not because some financial guru invented it, because this is what the mathematics of risk actually require, in a world that no longer rewards complacency. Part 5. The psychology of getting it wrong. There is one more thing worth saying before we close. The reason most people, most educated, attentive, financially aware people, get this order wrong is not stupidity. It is not laziness. It is a specific cognitive pattern that behavioral economists call present bias, the tendency to value immediate, visible rewards over diffuse, future protections. Investing $500 per month in an index fund feels productive. You can watch the number go up. You get confirmation that you are doing something responsible. The behavior is immediately rewarded with a sense of progress. Building a $17,000 cash buffer feels like standing still. The money sits in a high-yield savings account earning 4.5%. There is no exciting number going up. There is no sense of momentum. And yet this is the action that would actually protect Daniel in a crisis. This is the layer that would allow Sophie to navigate 6 months of income disruption without destroying her financial position. The financial industry, broadly speaking, has no commercial interest in telling you to sit on cash or pay down debt. Every dollar you put in a savings account instead of a brokerage account is a dollar that generates no fees, no commissions, no revenue. The entire architecture of retail financial advice is built to encourage you to skip the foundations and go directly to the products. Understanding this does not make you cynical. It makes you accurate. The financially intelligent person is not the one who discovered the best performing ETF. They are the one who understood the sequence, built the foundation, and then, and only then, put the remaining capital to work in markets they could afford to be patient in. Closing. So, if WW3 started tomorrow, not probably, not inevitably, but if it did, the person who would navigate that world with the least financial damage is not the one with the most stocks or the most cryptocurrency or the most complex investment strategy. It is the person who, before any of that, made sure they could survive 6 months without income, who eliminated the financial obligations that would turn a temporary disruption into a permanent crisis, who held some portion of their wealth in assets that do not depend on political stability or currency confidence to maintain their value, and then, only then, invested the remainder in the long-term growth instruments that the stable world rewards. Daniel and Sophie are not in a bad position. They are in a recoverable position. The gap between where they are and where they need to be is not a matter of earning more or spending less. It is a matter of reordering the decisions they have already been making, building from the foundation up instead of from the top down. The world may not be entering a third world war, but it is unquestionably entering a period of structural instability that rewards preparation and punishes complacency. And preparation, it turns out, looks much less exciting than most financial content would have you believe. It looks like a fully funded savings account, like a credit card with a zero balance, like a small allocation to gold sitting quietly in a brokerage account. It looks, from the outside, like nothing at all, until the moment it looks like everything. If this way of thinking about money made sense to you, the subscribe button is there. No pressure. But this is the kind of conversation we have here, every time.